There is a difference between a perpetual inventory system and a periodic system, and it's important to understand that difference because inventory may be one of the largest balances on the balance sheet, one of your largest asset balances, and inventory is a big use of cash, particularly if you're a retailer. So think about the inventory cycle. We're purchasing items, we put them on the shelf in inventory, we sell them, we collect cash, and some of that cash is used to make purchases of inventory again. So it's a cycle. So think about that when we talk about a perpetual inventory system, which means that the inventory account is updated automatically using accounting software. So to explain it, let's assume you go by Target and you buy a sweatshirt for $30 and Target's cost is $15. There's two journal entries that are going to come out of it. The first is we debit cost of goods sold and we credit inventory. We reduce inventory by $15, the cost. We're also going to debit cash, assuming you pay for cash, and we credit revenue for $30. So we have an expense debit 15, we have a revenue credit of 30, and the difference is an increase in net income of $15, assuming ignoring all their expenses, just to keep it simple. So importantly, the inventory count is automatically reduced by one sweatshirt. And this happens hundreds of thousands of times a day at a store like Target with that kind of volume. And management can automatically see inventory levels, when levels are down, when they should order, etc. That is a perpetual inventory system. Periodic is less used now because with technology, most people use perpetual inventory systems, point-of-sale systems. The example here is that we do a physical inventory count frequently, periodically. High dollar items are counted frequently, and high dollar items use a periodic inventory system. The best example is a car dealership. You're going to periodically go out and physically count all the cars based on their VIN number. Have you ever seen the movie Fargo? William H. Macy's character is managing a car dealership, and he's stolen one of the cars, and he's in trouble because the bankers are coming in to count all the VIN numbers to account for all the inventory because the inventory is securing a bank loan. So think about that Fargo example. Periodic system, we're going to physically count it often. Last thing to remember is even with a perpetual system like Target, you're going to do a physical inventory count once a year because that's the best evidence of the existence of the inventory. It also gives people, including outside auditors, a chance to identify obsolete inventory.